Hi. Running other people's money, also known as OPM, is totally different than running your own. I know of what I speak. When you run OPM, you are an agent. When you run your own, you are a principal. The two may look the same, but they sure are not. Now, why would this matter to you? It would if you somehow got enough money so you can stop working. What is commonly called FU money. How much is enough? It depends on your needs, family situation, ambition, and age. It can be 5 million, 10, or whatever else would suit your desires and needs. How can you get such money? Well, assume the money management firm you work for as an analyst or portfolio manager has been bought out by a financial behemoth and you were lucky enough to have options or shares. So one day you wake up and you have enough money to stop working and tell everyone else to go copulate with themselves. That's what FU money is. What now? Well, duh, you say you'll invest your money just like you invested OPM before. No, absolutely not. That's one of the surest ways to lose what you have and go back to being a wage slave. Why is that? Because when you invest on your own, you do it as a principal. When you invest for others, especially in a team, you are an agent. Agent in a team do stuff that has nothing to do with investing, stuff they don't want to do, but have to do. So eventually, this becomes second nature. This is something I point out to young people I occasionally mentor, mostly those working for large money managers. Don't think that what you do at work is running money. It's different. In what way, they ask? Well, the main differences between running your own money and running OPM are three. First difference, a large money manager has to adhere to rules that have nothing to do with investing, but all have to do with preserving one's job. For example, the famous risk parameter of beta, the squiggliness of the price line, says nothing about the risk of losing money, but everything about the risk of the money manager losing his or her job. In effect, minding the beta all the time prevents you from ever owning multi-baggers. How does it? Like this. Assume that your institutional portfolio has 20 stocks. Each has 5% of the portfolio. 17 of the 20 are ho-hums. 2 are losers, but one is a gangbusters multi-bagger, growing at 100% per year. So after 2 years, this great stock is 30 or 40% of your portfolio. What should you do? You should, of course, hold it. But bureaucratic OPM rules say that 30 to 40% of the portfolio in one stock is way too much because, you got it, it creates too much beta. So you'll have to trim the winner. And do what with the money? You got it again. Add to the losers because these will have their own champions among the team members. What will that do with performance? You got it yet again. It will be index performance at best. Or how about the opposite of the above? Say you own Intuit. Over the last few decades, it grew at about 20% per annum and is now a multi-bagger. But there was a period of 5 or 6 years in between where it stank and was down 60% temporarily before it regained its previous high. As a portfolio manager of OPM, you couldn't take a dip like this for more than a year. So you would have to sell it, probably to a principal investor who can hold it. The conclusion? Minding the beta means you'll never make real money by owning multi-baggers. Second difference between private money management and OPM. A big part of institutional money manager time is taken with bureaucracy, internal politics, and filling forms, like tracking your portfolio beta. So there's little time left for analysis and decision-making. Even worse, the information you can bring up in meetings is only the formalized numerical information. Yes, the kind I call ink and blips. You cannot mention that the president's secretary just told you her boss is going to have a Me Too problem and is going to be fired. Or that the company mid-level people say the CEO is a fool. In other words, when you run OPM, you have to adhere to official data and cannot use your own, the kind you sleuth yourself. But the third and most important difference between OPM and running your own money is that by its very nature, institutional behavior is group behavior, which always leads to losses. So To make your private money grow, you'll have to behave almost opposite to how you have behaved as an institutional manager of OPM. Specifically, no short-term horizon. Yes to private sleuth investing. Yes, acting opposite to everyone else and not giving a damn what they think about it. Let me end then with a concrete example of the current market. Almost every large institutional money manager of OPM is sure today that the world is ending tomorrow with a crash. How do I know this? Because I have friends both on Wall Street and Bay Street, as well as in Europe, and I checked. You're welcome to check too. And if you check with major banks who have brokers, or with major brokers like Schwab, you learn that today, cash as a percent of all assets in the hands of brokers' clients or institutional OPM managers is the highest it has ever been. Let me repeat, so the point sinks in. It is my estimate, shall we say, that cash as a percent of market asset is highest than it has ever been, ever. And that includes the 1982 market bottom, the 1991 pre-Gulf War bottom, the 2003 NASDAQ bottom, the 2009 great financial crisis bottom, and the 2020 COVID bottom. The fear of a crash is so high that everyone apparently is hoarding cash, also known as rocket fuel for market meltup. It seems that investors are today more scared and more panicked privately today than at all such times before. Institutional managers, that is OPM runners, who are always wrong by definition, are in cash. Why by definition always wrong? Because OPM are the market. So their panics make the bottoms and the buying euphorias create the tops. So if you work for a large OPM institution with everyone around you in the office deathly bearish, how can you come out and say you are bullish? Can you hold an opinion contrary to everyone else around you without being shamed? If you can, you would not work for bureaucracy for long. Bureaucrats, which OPM managers are by definition consensus seekers, comfort seekers, and dispute avoiders. And the stock market, of course, is one large noisy disputes. There to make money, you have to act at the extremes, contrary to everyone else. Indeed, to run your own money as a principle, you'll have to start thinking opposite to how you thought when you ran OPM. You'll have to start sleuthing outside the office instead of staying in, watching the screen, talking to people, and going to meetings. But to do that, to do what outside the office? Well, go read my book, The Advanced Sleuth Investor, then reread my first book and see for yourself. You'll have to learn how to be a principal after a lifetime of being an agent to others. Is it easy? No. Does it pay? Oh, yes. Is it fun? You bet. That's all for today. Let me know in a comment below if you like it, then subscribe. Retweet to all your friends subscriber so they subscribe too. Then go buy my book, Advanced Sleuth Investor, read it, and give it a review on Amazon, which I hope will be a good one. I'll see you next time, and meantime, thank you very much for watching.